All right, welcome everybody. Thank you for joining us tonight. And for those that have been in the other webinars with me, thank you for coming back. I'm glad to see you again. We'll start in about 1 minute. We'll just let it run through the cycle in 1 minute on without me saying anything for the YouTube later. For those that are wondering, yes, this is being recorded. Yes, Derek, there's going to be a part of entry and exit as well, yes. But it's more on design of the controlling risk within your portfolio kind of style. But yes, we'll cover that. I did a webinar on this entirely that you can always check on YouTube under Legacy FX. There's a webinar completely dedicated to entry and exit points where I give multiple examples on how to get a good educated guess on where the best entry points are going to be and how to get to certain profit points. All right. Good evening, everybody, and welcome to tonight's webinar, Trading Essentials and Security and Consistency. Now, before we get to the actual body of the webinar, please take a moment to read the risk disclaimer. That should do it. All right, so what are we going to discuss tonight? Well, first of all, I'll introduce myself really shortly so you have an idea of who I am, what I do. And then we're basically going to run through a few basic elements from risk management in the sense of portfolio balance and creating consistency in your trading. Now we're going to talk about limitations. We're going to look at exposure. We're going to look at risk and reward ratios and trade management. And as somebody asked, yes, things like entry and exit will be discussed as well. Now, for those that are on YouTube, the last part will not be there for you, but obviously those on the webinar, we will then go to the Q&A at the end where you guys can ask me any questions that you may have that you came with along the course of this webinar. All right, so let's start at the start. About me, who am I? Well, my name is Mike Rotting. I'm Dutch. I live in Athens in Greece. Married, kid, dog, weird fish, and you know, in my off time, I like to do things like golf, sail, go to the beach. So basic standard stuff. Now, for my trading history, I've been trading about 15 years in Forex now, a little over, I think. It kind of started in the Netherlands, actually. When I was in college, I was doing international business studies, a Cambridge program by Deltion, and I figured I had a kind of a knack for just figuring numbers out and patterns and stuff like that. So I rolled into what is now known as Forex. Now, like most of you at the start, didn't do too hot. Obviously, young, eager, you know, everything sounds nice, get rich fast. It didn't take very long for me to realize that, yeah, this is not going to work, I think. And this has to do with just, you know, your basic of being greedy, and just trying to get something to work that just doesn't seem to work in this market. So after, you know, blowing up 2 or 3 accounts like most of you, I basically went back to the drawing board, decided, okay, throw everything in the bin that I think I know, and let's start from the very basics and build it up one basically knowledge block at a time. So fast forward that resulted me into getting a profitable account and figuring things out what worked for me, and then consistently have a profitable account throughout the years, building up to get to my goal, and then rotate into what do I do. So for the last 6 years or so, I've been doing these webinars. This is part of what ties in the second point in the mentoring, is trying to pass on a little bit of the knowledge that I've built up over those years of what worked for me to maybe help you, you know, progress your trading, or if you're a starter, to try avoid some beginner mistakes. Just try to get you to approach trading differently. and get people in the right path. Obviously, I can't make it for you, but I can show you what worked for me, and then hopefully you can take away from that and try to avoid some of the basic mistakes that I made along the way. Now, mentoring obviously ties in with this, and my other projects are mainly investment or financially related. It'd be a startup company, and that could be marketing, that could be strategizing, that could be before this, I was also doing things with financial advisory, looking at offshore investments and things like this. So yeah, it's a little bit everywhere. I just like to keep myself entertained with new things. But that's enough about me. So risk management, and more in the sense of creating consistency for yourself, balancing a portfolio of trades, or to learn how to build up a portfolio of trade and then maintaining them. We're going to look at knowing your limitations, the exposure, and risk and reward. And underneath that, there's more topics. So let's look at knowing your limitations. So the first thing I run into a lot when talking to especially newer traders is unrealistic expectations of what they can achieve in this market, and not in the sense of like, hey, it hasn't happened. No, people have won the lottery, but that doesn't mean that if you buy a ticket every year, you're going to win the lottery. Just because something has happened doesn't mean it's going to happen for you. And betting on the off chance that it's going to work out is not very in the style of what investments are. You really need to set up yourself to understand it is an investment. Look at a 5-year plan, a 10-year plan, and set up an expectation that fits to that. Obviously, with a smaller account, it becomes harder to make it grow. It is a market where money makes money, and this will become a little bit more evident later on in this webinar, where more money means less risk. And that might sound a little weird at start, but when you have more money, you can diversify better. You have access to other opportunities that with a smaller account are very difficult to handle or set up or trade. And this means that for your expectations, you need to understand what bracket you're in. Now, obviously, there's nothing written in stone, but I usually divide it in the following way. Anything from a 500 to a 1,500 account, and that'd be dollars, pounds, or euros, it doesn't matter. Anything in that bracket, you should stick to majors and minors. I know that it's very tempting to do indexes and do commodities and do oil, but the reality is if you look at how these things are traded for a consistency basis and not trading within like hour frames and 2 or 3 candles and try to grab a little bit here and a little bit there, which every trade is a risk when you open it, it doesn't really set you up for a path of consistency. You're going to be constantly fighting yourself and meaning disappointment. So what's the expectation is that, putting in $1,000 into your account, let's say, and expecting to walk away with $50,000 at the end of year one. Some of you might laugh right now saying that, but I've had people with that expectation. I'm going to put 1,000 in, and in 3 years, I'm going to be a millionaire. Okay. It's not like it's impossible or hasn't happened. The probability of it happening, though, is you betting on a 0.1% chance of that happening. It's like buying the lottery. Yes, you could win, but probably you won't. Right? So what is a realistic expectation? Well, generally speaking, you want to think of it as an investment. And generally speaking, you're looking at 10% ROI. But if we look at 12 months, that's your trading period for a year, 1 calendar year. If you would put yourself up for a goal of 40% growth, the banks couldn't touch you because they will never match something like that. And this is setting you up to try and achieve 4% growth a month, a little bit less, 3.5. Now, this is realistic because you need to understand that every time you win and you grow the account, and this will come in later when we talk about lot sizes, fixed versus variable, and risk levels, that once you grow the account, you increase your capital, allowing you to use more resources and allowing you to go in bigger and allowing you to diversify, which makes less risk and more profitable, and you get an exponential curve. So you will most likely, once you get the hang of it, go way over this 40% target at the start. Obviously, when you have $100,000, 40% is an insane amount of money. So your target needs to be adjusted a little bit there. because it's still doable, but you might want to slow it down a little bit, right? I usually put this in a very simple perspective. If I give you 10 euros and I tell you to come back with 15 euros at the end of the week by turning that 10 euros invested in something and come back with 50% ROI, it's really hard. You don't have many opportunities. I mean, some people are now thinking, okay, I'll flip stuff on Amazon. I'll buy 10 euros worth of merchandise and flip it for a little bit of profit. All right, then you need to think about expenses and trial. Getting that 5 euros back is pretty hard. Now, if I give you 1,000,000 until you come back with 100,000, it becomes a lot easier. Now, some will say, but yeah, but the one is 50%, the other one is only 10%. Yeah, but if you look at the total value, right? Even if I tell you back, make 1,000,000 into 1.5, you have so much more opportunities available to allow you to do something because you're going to invest all the money, right? So do the same with your account, right? Have an expectation and don't make $1,000 account and then go like, okay, I'm only going to risk 20% of my account. That doesn't make any sense because you're making €1,000 account to trade with 200, then make a 200 euro account and trade with a 200. But your capital is what allows you. You need to set it up. But people are afraid of losing their money. So there's a way that you set these things up. So you have a drawdown in your account at a maximum and you control this. And then obviously as you time progresses, you will see that if you have a 45% win rate, you have a profitable account if you do it right. So you don't need to have an 80% win rate or nonsense like that. It'd be favorable if you have, but you don't need it. Now, when it comes to setting a goal that ties in with this expectation, right? So what is my goal? Where am I trying to go? A lot of people start an account and just like blindly go into it without actually thinking, okay, what am I trying to do? And keeping in mind the first bracket, it's like, okay, I have a €1,000 account. My goal being buying a Ferrari at the end of the year might not be that reasonable. If your goal is, I want to grow this over the next 10 years to a basis where I can invest that into my pension fund, for instance, now that's a goal I can get back, what I can get behind. Because you're looking at it at investing, reusing the gains, not taking your and shrinking your capital along the way, probably adding a little bit to it and growing it. Now, what that goal is in a figure, that could be different things, right? Obviously, if you start with 1,000, don't set up a goal in 10 years of 2 million. That'd be pushing it, right? But if you think about growth, it's exponential, right? 40% over year one. Then you go from 1,000 to 1,400. But then your 1,400 is your new 100% and get 40% over that. And this is how this grows, right? It's almost like compound interest with variable. So what do I trade? Well, this is where the bracket thing comes in, right? I mentioned. So 500 to 1,500, I usually advise people stick to the majors and the minors. There's plenty of trading opportunities in them on a daily basis, and especially on a weekly or monthly basis, that you can find enough trades for your account to grow with controlled risk. You don't need to go looking into majors and Bitcoin and CFDs, like oil, gold, and things like, and try to day trade or intraday trade these. If you think about how much these other commodities move, like oil and gold, how much they can move in a day, think about the way that your stop loss would have to be outside of daily range just to make a slightly longer term trade. And if you do an hour trade, you need to understand that if you do something in a commodity like that is basically a long-term investment kind of deal, you're trading something in the hope that when you go in, it never goes against you. And we all know that it goes up and down all the time. So the chances of you hitting your stop loss is actually pretty high because you're not going to set up in a 1 hour view a 6,000 pip stop loss, which in things like oil could be the stop loss correctly above the levels where it should be. But then you're also talking about a 20,000 pip take profit, right? And this might be a weak trade, right? You need to understand how big these things really are. Yes, lot sizes have different values there, But again, if you only have €1,000, then even if you could fit that in because you time your entry perfect, your entire capital is now tied in to one thing. So that is not a thing you want to trade. What you want to trade is something where you can take multiple trades, and we're going to talk about exposure and other things in a bit, where you can build up a portfolio of different trades that cover each other. Not necessarily as a hedge, but you set it up that you have some fast movers, some slow movers, and something in between. So you create a balanced portfolio of trades, and you have some backup trades that you eyeballed before, that you've analyzed, you've done your mitigations, because once your portfolio is set up, right, in the 1,000, the 500 to 1,500 bracket, and you're doing majors and minors, you want to have to be able to switch a few trades out. Now, this could be 5 trades, this could be 10 trades, depending on the percentage of risk per trade. We'll get back to that later. Now, if you're in the bracket of, let's say, 1,500 to about 5,000, you start crossing into, from 2,000 to 5,000, you start crossing into looking, maybe getting an index in there, or maybe getting some stock in there. But with stock, you have to have a different approach to technique. You need to understand the companies behind it, et cetera, et cetera. Once you go past 5,000, 5 to 10K, this is where I usually say now you can start adding commodities, because you need to look at something that's a little bit more long-term. Commodities are very price range. They're very price demand, supply demand kind of oriented. There's a lot of different variables you need to keep in mind of. So you want to really be able to set this up for the long haul and just let it run. Right? So that is, for me, the consistency. If you are going to trade something that is stable for long term, then you should trade it long term. Okay, so 1,000 to 500 majors minors, 2K to 5K you add indexes or CFDs like stocks, and then 5 to 10K and 10K plus you start adding commodities until you get to institutional accounts. Then you get a whole different makeover, and you create a completely different portfolio buildup, because you also start adding completely other things, probably non Forex related. But if you have a pure 100K Forex account, then you just expand on the amount of portfolio trades you have. Okay, so let's talk about exposure. So exposure comes in 2 basic ways that I want to highlight this. First of all, there's global influences. Now, here's where I'd like to join you guys into the chat. What kind of global influence do you think I'm referring to when we talk about trading and your portfolio of trades? Who wants to take this one? So what kind of global influences can you think of that you want to control your exposure to? Okay, war. Yeah, war is a good one. That's a global influence. Yeah. The Fed, macroeconomics, absolutely. Geopolitical events, perfect. So yeah, so you can understand from what I just read out, from what people tell you, it's the big events you have no control over, and it's not things like fundamentals. It's not the economic calendar. Right? That's not a global influence. Like, these are pre-scheduled. They're usually factored into the price, especially with the volume we have nowadays. If you look at global influence, what could affect a market? And it could be a global market. In that case, there's really hard to really balance that out. But there's always, and I say this, there's always a winner. Yeah, stock market crash, pandemics, please don't crash the Dow Jones, but yeah, stuff like that. So anything that just randomly happens that we can't have any influence over, any control over, you want to make sure that you keep in mind, how do I have a portfolio that is a little bit protected against everything at once? This is really hard to do, and you do need to keep in mind where there is a way that you at least secure and set up, and we're going to talk about this a little bit later on, stop losses and stuff like that, where you want to make sure that your exposure, for instance, isn't all US dollars. Because if something happens on the NASDAQ, well, I can guarantee you the US is going down, or the S&P 500 to make it even simpler. unlikely on the S&P 500, but right, you get Dow Jones, the Nasdaq, stuff like that. Like if something happens there, and you have 10 trades open, and they're all related to the dollar in one way or another, what do you think your portfolio is going to do? Now, it might work in your favor 10 times. Of course it will. You willing to take that risk? Really? You really feel comfortable that you're going to win on a coin flip? That it works in your favor? No, of course not. Right? So think about this. How do I protect myself from global influences? This is also more relatable for those that have a little bit of a bigger account. If you're doing CFDs and stocks, keep this in mind. What other influence do I need to keep in mind? What market segment am I investing in? Right? If you're only buying Netflix, Zoom, Skype, Microsoft, you're buying all tech companies. Something happens in the tech company, in the tech world, you're going to get affected on all of your trades. Why not spread it out? Right? A little bit of tech, a little bit of state, a little bit of cash. Right? Sectors and industries, spread them out. Exactly. Sectors and industries, right? So you spread out your own risk. And this is what exposure basically really is, right? And that ties in with spreading your exposure to different securities. That protects you from global influences, that also helps you from other things, and it helps you to control how you build up your portfolio to have a balanced risk. So let's say you are, and I'm saying this, I know there's some of you that have bigger accounts, but please bear with me, the vast majority of people have around $1,000 account, so we're going to use that as an example. At a $1,000 account, you trade majors and minors, and you have no idea how often I have people come to me, they show me their trading history, and it's all Euro US dollar, or Euro CHF, or US dollar JPY, or GBP USD, and the only thing I can think of is like, why is everything dollar? Yes, you have 6 trades open, of which 5 are in the dollar. So if 6 is 100%, right, or let's say 5, right, you have 80% of your portfolio exposed to any news that happens in the US. That's not healthy, right? So I usually give a staple 20%. And then you can make it simple. You have a maximum of 10 open accounts at 10 open trades at any given time. And we'll get back to how that works out in risk, that you are still not using your entire balance, but this is perfect if you're a little bit starter. That you keep it to 2 things. So if you see an opportunity in the euro market, it could be Euro US dollar, it could be Euro JPY, it could be Euro GBP, whatever it may be. Please don't say Euro CHF because it's like watching paint dry. Great for practice though. But take 2 of them. Take the 2 best ones you can find in the euro pair that you're confident with, that you can see that on your technical analysis, your indicators, whatever you may use, that everything is fine. There's no fundamentals coming up that can maybe accelerate or go against you or otherwise mess with your trade. If that's the case, or unless you're a little bit more advanced and factor in the fundamental analysis or safeguard against it before it happens, then you have 2 trades of euro and they're going to be paired with something, right? So let's say you have a Euro US dollar and a Euro GBP. Now I also take a US dollar GBP. Now I already have 2 US dollar pairs and 2 GBP pairs and 2 euros. So whatever my next trade is, it can involve dollar, pound, or euro. So you end up with things like AUD CAD, right? So you can already see that you're spreading your risk out over different. Yes, there are some tie-ins between the markets, how they're correlated to each other. I understand that. But in the grand scheme of things, that correlation is not that strong that it's going to screw up this whole system. Right? They're still individual markets. There are some points where this can be argued, but this is when you're trying to more min-max things. Now, so if you have this, right, and you build it up this way into 10 trades, and you have about 2 exposures to all of them, you have a nice bracketed spread of 20% exposure to any given individual currency or region, right? This means that in 10 trades, if something happens on one side of the ocean, it will benefit you on the other side of the ocean. And considering that you are forced to spread your risk like this, if two go down, two go up somewhere else due to the influence. Now, they could all be winning trades. That'll be the day. They could all be winning trades. And then this comes out and two turn sour. Then the other two will accelerate because they will benefit from it, from whatever the turmoil is happening somewhere else. Right. So this is how you spread out your portfolio and kind of protect. So this is how you kind of counter this. And when you identify these things happening, you cut your losses on the bad pairs and replace them with something else, which is the ones that you were eyeballing, your backup trades that you then replace them, or for trades that haven't developed over a few days. Now, if you're somebody that's an intraday trader, let's say you've been waiting for 8 hours still at the entry point, just get rid of it, get something else. Right? If you're insisting on trading within a 24-hour time period, just get rid of it after 8 hours. If it hasn't developed, why are you still waiting? Like, do something else. Okay. So if your account's a little bit bigger, now you spread it out over even more things, right? So now you have some majors, you have some minors, then you start adding indexes, which are like kind of more like your foundation. They're like the stable growers, or if you look over the years, right? They grow an X percentage per year. You could basically just turn them on and just let them run. Then you have, not exactly that simple, but then you have some stock, from companies that you understand, that you know where they are in and know where to find their information. This is important when you do individual company stocks. I advise this against beginners. I would recommend this if you're a bit more advanced. And then you get a little bit further. Now you start adding commodities. So you add a little bit of oil, you add a little bit of gold. You keep an eye on how the Chinese market is developing because of supply demand for oil. You look gold. And then for oil, obviously, we keep an eye on the biggest consumer, the US, and everything else happening. Like right now, you have Russia, right? So in the Middle East, we have to keep an eye on all that. So the more you expand your portfolio, it also brings more work to monitor and keep an eye on all these things that might be happening. Now, when it comes to exotic pairs, these are your final step because they take a lot of practice. They have high volatility. They have completely different lot values, generally speaking, that you can look up easily. There's third-party websites where you can do that to get an idea of what the lot size is. But what the actual value of your lot size will be. But they're usually very volatile in the sense of they have a lot of wicks, or they have very big noises, big swings. Like they are exotics, right? So these are more of your risk reward kind of trades. Right? And now you build up. You have something stable, you have something a little bit more balanced, and then you have a few risky ones in there. Now you have a nice balanced portfolio. You have to spread your exposure over different securities, different market segments, different things, and you have no exposure more than 20% to anything. Now you have a nice balanced portfolio. That's easier said than done, though. It'll take some practice. Now, obviously, if your personal risk appetite is a little bit higher, you can go a little bit more, but I usually just point out 20%. Right, so, hey, wait, did we just go backwards? Yeah, we did. All right, so one of the other things that we look at, and we are going to go to a chart later on, by the way, for those wondering. Risk versus reward. And this is, for some, a little bit basic, but just bear with me here. So a lot of times you get like this, like, oh, it should be a 1 to 2 risk. It should be or 1 risk to 2 profit, right? So 1 to 3, 1 to 4, 1 to 5. What is the rule? Okay, so basically what you want to have is 1 to 3 at the very least. However, it's just not realistic. I hate it when they say, oh, all your trades need to be 1 to 3. It's not realistic. The market's not always going to give you the opportunity to get a nice 1 to 3 trade. The range might not be big enough, even if your entry is perfect. However, if I take 100 trades out of your portfolio, it should average out to at least 1 to 3. Sometimes you close them early. Sometimes you have a trailing stop. Sometimes you close them way too late. Sometimes you didn't pay attention and did everything wrong, and it went to your stop loss, even though it was green at first. Like, there's 100 different variables, and let's be honest, most of you have a job. You're not in front of a computer or with 3 or 4 monitors and doing nothing but trading all day long. It's just not realistic to say every trade should be 1 to 3. Sometimes you're going to have a trade that's 1 to 1.2. but you're like you're like everything is screaming to you, this trade is a trade. It's a good trade. I want to take it. Then take it. But keep in mind that if you're taking a one-to-one trade, you can't keep doing that because you want to average out 1 to 3 at least. So sometimes you're going to have to skip a trade, and that's okay. You're not trying to be a signal provider. Like one of those social trading platforms. You're not trying to make 300 trades a month just to show that, look, I can pick trades. No, your goal was something else. Your goal is to grow the account, I think. So it doesn't matter if you do that in 1 trade per year or 100, right? Quality over quantity, guys. Pick good, solid trades, wait for your time, grow some patience, and then go. Okay, so that's one. I hope everybody's clear on that. So average, you want to average out of 1 to 3. That's usually what I advise. Obviously, you want to go higher, go higher. I wouldn't advise going lower. Now, variable lot sizes versus fixed. Now, there's a whole webinar on this specifically where I pull out an Excel sheet and show you exactly. But basically, think of it this way. If I use a fixed lot size, and usually that's paired with like fixed take profit stop loss levels. Like if I take 20 pip stop loss, I'll take a 40 pip take profit, right? Remember the 1 to 2 rule that you then fix into your trades? Here's the problem with this setup. If you do this consistently over a prolonged period of time, you create a linear growth. So whatever you win is whatever you lose at the same time. And if your win rate is 50%, you end up not growing the account. Or barely. If you hit a few of the bad ones, then probably not. Now, if you look at variable lot size, this allows you to use technical analysis, which we're going to do in a bit. It allows you to judge where the support resistances are, where the tops of the channels are, and pick the right entry, and then put your stop loss where the market should not go unless it breaks trend and resistance or trend and support. Right? It should just not go there. And when it does, thank God I have a stop loss, because this would have just kept going and I would have lost a lot of money. That's the point of a stop loss. Okay, this I judged wrong. It went against me. It completely broke everything. I got to recalculate. Maybe I overlooked something or I forgot the fundamental or whatever, but I hit that line. And now you need to understand that the distance between entry and stop loss is just a number. 30 pips, 100 pips, 200 pips, who cares? It doesn't matter. It has no value until a lot size is attached to that. And now you can do the following thing. Part of this risk reward, why you want exponential growth, is you can use a percentage risk per trade instead of a fixed monetized risk. Because now you're scaling your account automatically as you grow. But at the same time, let's say we start off at a bad foot. Let's see, but let's be honest here, it can happen. You start off on a bad foot. By using a percentage, your new 100% that you start with is declining if you're having a losing streak, and you're slowing down your decline further and further. You're basically slowing, you're buying yourself time to get back into it. And then when you have this curve and you start catching back up, you catch up much faster because you're doing percentage on percentage. Your new 100% is constantly getting higher. So you're almost exponentially growing the account. So let's say you take a 3% risk per trade. And we're going to do this in the chart in a minute. I'll show you how to calculate this. What if, okay, if I have a $1,000 clean account, start new, 3% is very simple. It's a $30 risk, right? So if I have a 30 pip stop loss, I can take it on one mini lot, which equals $30 on majors and minors. And voila, I'm trading a mini lot. And I'm only risking 3% of my account. But let's say the stop loss is 60 pips. Okay, fine. I'll take 0.05. I'll take 5 micro lots, and boom, I do 50% per lot. I'm still risking the same 30 euros or dollars or pounds or whatever your account is, but my stop loss is double. I can play with this all day long. Now, the thing is, you will see that when you grow this, you also now can fill in that if I have a portfolio of trades and I open 10 trades at once, well, wait, they're all 3% risk, so I'm only risking 30% of the account. I actually have room for 20 trades. and I'll be risking 60% of the account. Now, for most, that is too much. And especially in Europe, where you have the margin call thing, it's the free margin of 30, you can only use 70%. Use 10 to 15, you go 40% of your entire account can be down draw, you will never get margin called. It's that simple, you will never get margin called. Right? So even if all the trades that you open, all 15 trades, decide to just hang in the negative for a while, all at once, 1 pip off your stop loss, you're still not having any problems. And then they'll bounce back. Unless you literally picked all 15 wrong, which is very unlikely, right? Remember, more is less risk. You're spreading out. If it is a coin flip, literally if you wouldn't do anything, no technicals, nothing, and you literally throw a dart at a wall, and whatever number it hits is a buy or a sell. You do that for 15 trades with the correct lot size setup. You're still gonna win 1 or 2 of them. Right? Now, micromanage can help you boost that. So you get fixed stop losses and moving stop losses, right? A trailing stop. So here's where we usually get a lot of debate. Now, obviously, every trade you start should have a stop loss, unless you have a specific strategy like martingale or swing trading. That's a completely different bracket, and it's also from a completely different bracket of account size that you do these things, right? So I am going to assume that nobody does that here. Right, they're a little bit outdated styles anyway, but they are very productive if you have $100,000. This is basically institutional account trading, right? You start doing things like martingale. Now, if you think about a fixed stop loss, let me show you what happens on a chart. So here we have, this is a demo account with legacy effects. So let's say we have a fixed stop loss. Guys, throw a number at me. What's a fixed stop loss you guys like to use? Trick question. No. What is a fixed stop loss you guys think is pretty often used, like as a number? Just throw any number at me. Come on, somebody. There we go. 50. No, 50% is not a stop loss. Give me a pip number. So I'm pretty new. I have $1,000 account. I trade with a fixed stop loss of what amount of pips? Okay, 100 pips. All right, cool. Let's do 100 pips then. All right, let's do 100 pip stop loss. Let's see how this is going to work out for us. All right, so let's do a quick and dirty analysis here. What is this? High there. I'm gonna do this really quick and dirty. Please don't take this as anything else. I think this is about right. It seems to have accelerated, so let's try this. Yeah, that's about right. Let's make this thick. All right, this is just for an example. Actually, Jesus, almost perfect. I know that because I did it last week, but that's okay. All right, let's slap some horizontal lines in there. Bloop. Let's go. This is the market price. Okay, the next one is going to be roughly there. This is probably with wicks. This is probably going to wick as well. Yeah, it does. All right, perfect. So then we'll take that one. Identify lowest point, pretty easy. Is there anything in between? This one or this one? This one if this wicks. Yeah, I guess. And then let's slap this one in there because that one seems to be wicking there as well. We want 3 or more connection points generally speaking, but that's a whole story. We're doing this quick and dirty. I'm good with that. All right, so let's take these examples here, right? I'm not looking in the past to see if this matches. It's not important for the example. Okay, I want to, well, we're in a downtrend, so blind mat, I want to take a sell. We're going to go back to this one later, but okay. We'll take a sell. All right, you said 100 pip stop loss, right? Okay, so I take a sell and I put it at 100 pips. That actually puts it right here. So in this case, we're outside of trend, outside of resistance. Nice. We like that one. Oh, okay. Well, let's try it on. Let's try it on GBP JPY. Okay. Let's just let's try it on GBP JPY. Let's see how it works out here. Okay, again, we're going kind of down, but not really. This seems to be a little bit of a slope, so it looks more like it's here. That doesn't add up though, because we have an acceleration, but that's okay. Let's just take this for an example right now. 100 pips is like right on the marker here, just right there. So if I go in right here right now, my 100 pips would be right here on literally the wick. So if you went in too early today, you would have already hit it, but let's do a quick line scan. Okay, we got this bottom. Does that wick? Yes, it does. Okay, we can get that one lower, but it doesn't matter. And we could do this one. I wonder if this wicks. It does. Okay, so it's something like this. Okay, good. So we got a resistance, and then let me see if this line that we actually drew here is actually somewhat of a support resistance line. Well, this is probably 3.123. Yeah. For those that are wondering, am I going too fast? This is really quick and dirty, and don't really take this too serious. So there's 1, 2. If this wicks, then it's 3, 4. Yeah, okay, I'm good with this. So basically, there's not really any strong point in between. I know this is a day chart. You can do this on an hour too. It doesn't really matter, right? If this is an hour or a day, I'm just doing it on a day right now, but the rules apply the same. Okay, so my stop loss would now be 100 pips, we said, right? So if I go in on market price, my stop loss would be there. No, actually a little bit higher, up there. Yeah, something like that. Would you feel confident, if this is an hour chart, would you feel confident with that stop loss, or would you rather have it, well, maybe it belongs here, outside the next resistance? Because if it just does this with a big wick, like it clearly can do, bounce and then go down, I'm good with that. But this is the problem where you run into with a fixed stop. Like now 100 is pretty large. A lot of people do like 50 or 60. If you do any of those numbers, anything under 100, you'll see like here, this is 40. 60 is basically here. It's right there. Well, you would have already been out. Perfectly good selling opportunity probably, and you lost it because your stop loss is too tight. Now, if you use, and I did this 2 weeks ago, by the way, because the last time we were with the webinar, this webinar, we were on this candle. Identifying the possible entry point. If you can see this and the lines, if you do a fixed stop loss and you want to go in a little bit earlier, like you want to be outside trend, outside resistance. So by doing technicals with a variable lot size system, you can always determine where your stop loss is going to be from ideal entry. Now, why is this the ideal entry? Well, we're looking at the bigger picture. And in the bigger picture, we're in a pretty significant downtrend. We're currently trending up to the top of the channel. But if you think about probability, and this is mainly for a small account, what's more important? Waiting to trade, not specifically with the trend, but wherever the volume is moving, which is most likely going to be a sell, you are going to wait for confirmation first, close underneath, have a red day, and then go in, right? Or wait for price action for those that do price action, which is more an hour thing. I don't want to reveal that yet. So you do your top-down analysis, you have your indicators. So let's say you have triple moving averages, RSI, stochastic, maybe you do Fibonacci as well, whichever it may be. But with a variable lot size and a variable stop loss, you can always make sure that your stop loss should only be hit if this breaks. Like, this is the biggest wick I can see recently. So let's measure the distance of this wick. That's 100 pips. Okay, so let's say we go in here and it wicks through for 100 pips. It goes to here. Okay, then my stop loss goes here. And that's if it's like right under this line and goes straight up, right? If it does like literally straight up this. And as a wick. But that can only happen if there's a reason for it. Here, it was within the channel. What was the biggest wick outside the channel? Well, let's look a little bit at the past, right? You can do that as well. Like here, we have something there over there. Hey, don't do that. So here we have, like, let's say something like this. We pull it over the bodies. All right, this is a wick outside of it. Let me do it next to it so you can see. 30 pips outside, small. And here it broke it. And then it accelerated. And now we're here, right? So it's unlikely that it's going to go more than 50 pips outside this range, which would bring it pretty much, yeah, just underneath this resistance. So if it goes past this, it actually needs to break both trend line and the resistance above it. Your stop loss is safe. So you open this sell, but oh wait, no, I forgot something. I can't open this sell yet. Let me close this again. I did something stupid. Variable lot size. Oh yeah. Well, if this is 168 pip stop loss, I have $1,000 account for this example. I take 3% risk. What's my lot size? For those that are confused on how that works, for majors and minors, most of this mini lot is basically equal to $1. Not exactly, it's a little bit less and a little bit more. I know that, but long line, you don't have to keep it yourself simple, right? You don't have to calculate 79 cents per lot and stuff like that. Take $1 for a mini lot. Well, if I have 168 pip stop loss and I take a 1 mini lot trade, that's $168. Well, my risk level is $30. That doesn't work. Okay, so what if I cut that down by one lot size lower? I go 10 cents. Now it becomes $16.80, right? 168 is $16.80. Well, I can fit two of those in there. Right? 2 times 16 is 32. Add the 80 cents, it's 33 and 60, something like that. Okay. Oh, wait, I just calculated it then. It's not one micro lot, it's 2 micro lots. I can take the sell and set up the stop loss where I want it, because I know that it should be outside range of, I don't need to put it here, right? I don't need to do this. Sure, it shouldn't hit this, but also why are you still in this selling trade by the time it gets there? There. Should be outside range, should be outside. This could be a long-term one. We'll do the same thing on an hour in a minute. And I take profit. Okay, take profit. How do we factor the take profits? Well, we're going to go down to this line here first. So that could be take profit number 1, take profit number 2, and then the next one is like wherever it hits the channel based on the average angle that it takes to get to the bottom. Right, so extrapolating that would be the take profit would be there. Okay, let's take a look at how the new bottoms are created. Bottom 1 to bottom 2 is a 350 pip drop. 100 pip drop. Well, that's a bit of a difference, but this is not really a drop. It's kind of like a little extra dip. So that's 340. We'll do the same thing again. Actually, that adds up pretty good. Okay, so let's go save. A little bit less probably. What's my ratios? 162 to 475. I'm good. Easy peasy lemon squeezy. I'll come back in a month, see where it's at. It's probably going to be done in, well, we just calculated the average angle. This should take about 15 days. So about 3 working weeks. Now for most of you, that's, I'm not doing that. All right, fine. We'll do your hour trades then. So here I did a little preparation. What's my scenarios? Well, that was my entry point that I calculated. This is what it looks like in an hour. So we're inside my perfect entry moments. And for an hour, I can fine tune this. All right, so this was 2 weeks ago. Okay, it hit it a little bit earlier and then again later. So this was actually the average, pretty good. And we're actually following that line pretty good right now. All right, so let's zoom in a little bit because obviously it's too small otherwise. We know this blue line is the daily channel. And then we have the resistance above that. Now the daily ones are going to be somewhere over here. And then Probably 1. And then we get the daily one, so I don't care about the hourly ones at that point. So let's say this goes up a little bit more like this line, but ends up a little bit faster. Let's say this one goes up, then back down, it hits here. Let's take that scenario. Let's say it does this. We're still within our circle, which is fine. This is the next candle. I expect it to close here, open there, and go down. And it does, I don't know, this. And then it wicks through, right? On a day channel, I just care if it closes underneath this, but it means in an hour, it can easily just go hang around in between these two levels and eventually in the last few hours go back down and close the daily underneath the daily resistance where I want to be, right? So let's say it goes in here and it comes like somewhere around here. Well, obviously I want to grab the entry there then, because the stop loss, is not going to change. Still going to be that same level. This is where the stop loss should be. The only thing that now differs is on an hour, I get a slightly better entry point for a trade that I can make into a long-term trade if it develops correctly, or I can keep it as an intraday trade and just after 20 hours just close it. But then you screw with the ratios. So then you have to be careful on how often you do that. It's okay to let trades go long. So now we have 100 pip stop loss. We shaved 50 pips off of it. So 100 at a micro lot is $10. This trade I can actually take at 0.03. I actually added a micro lot, but guess what? The take profit is still the same level. So what does that mean? So instead of getting 460 pips at 20 cents each, which is, let me see, it's 80 is 90. Somebody help me out, brain's slow. $93 on a micro lot trade, guys? $93 takes about three working weeks. Now my hourly trade, hourly entry, correct stop loss where it shouldn't be going. Right? If you're going to monitor the hourly, you can probably tighter. But again, most of you work, so don't do that. Now I have a better entry point. My take profit is the same. I actually added, right? What I took off from the one side, I added on the other side. So now we have a 575 pip take profit and a higher lot size, 0.03. Right? So 30 cents per pip. So at 570 pips, that's $57 per micro lot. Times 3 is 150, 164 is 100, work with me here, 172-ish? Something like that. $172 on your $1,000 account. Congratulations, you made 15% ROI in one trade that had basically fairly little risk. And you're risking 3% of the account. So you know, I only have this one. You're going to add this one. And you're going to add CAD AUD, and you're going to have a bunch of these trades. Some of them are going to develop as an hourly. Oh, well, this is from 4 weeks ago. I guess that upheld. Well, there was our entry. We missed it, but it actually bounced back, so we can take another one. Okay, so moving stop loss. We have our fixed stop loss now. Right, so let's go back to this example. Well, we identified this as the first, let's say, take profit number one. Some of you already know what I'm alluding to. What's a moving stop loss? Who's following me on that one? And I know this is like one of those love-hate things. Some people say it's terrible, other people say it's fantastic. What is a moving stop loss? Did everybody fall asleep? No. Okay, good. Yeah. Close, Ashley. Yes, thank you, Derek. we're talking about trailing stop loss. So after you've opened your trade, you can then set up a trailing stop. But now you get this thing like, well, trailing is bad because it follows your and then it hits the trailing stop and it goes to the my take profit later. Okay, this is if you have this problem consistently, your trailing stop is not big enough. If that's one. Two, there's a way to calculate it. And if you're trading on an hour, if you're moving on an hour, so let's go to an hour chart, we are going to be selling, right? So in a selling movement, what is the max retraces we see? All right, let's do an average calculation. So here we're selling. This is in an uptrend, so we have to go back a little bit. Let's find the last time it went down. Here we go. So this was all hourly down, right? Here, this was down all the way from here. So let's see what the pullbacks are. We go lowest point to highest point. 21 pips, lowest point to highest point. 24 pips, lowest point to highest point. 20 pips, lowest point to highest point. 50 pips, lowest point to highest point. I think most people get what I'm doing. 40, 50, 40, 30, and I guess this one too. 20, 20, 40, 60. Well, that hit your take profit, so it doesn't matter. Right, so we got 40 pips, we got 60 pips, we got 50 pips. On average, we had like 10 different pullbacks, and the majority of them were between 40 and 50, with one exception of 70 and a few smaller ones of 20. If you just write them down and add them all up and then divide them, what do you get? You get an average. But you don't want the average, you want slightly more than average, because you want it to only hit your trailing stop if it moves back more than what it normally would. So on average, we saw between around 55 pips. I think that would be the average. So take a little bit more at 10, go 65. Right? Obviously don't add like an extra 100 pips because that doesn't make any sense, but like just use common logic. So let's take this sell up. So let's say here's your sell, your stop loss is where is over there, and then your take profit was like over there. Now, if you're in an hour trade, guys, and it's over here, your trade could look something like this. Take profit, entry point here, take profit here. You go one to the first one. Now you see that the ratios are going to be slightly different. That's 100 to 200. It's a 1 to 2 trade. This is on an hourly chart. This is when it starts to turn. And if we look at the average angle that takes, it should be roughly like this. 55 hours. Still not within a day, but it's pretty safe trade, right? There are other pairs that sometimes allow you to trade a little bit better. All right, so now we calculated our trailing stop, which was 650 points. Remember, trailing stops are in points, not pips. So add a 0. If you factored in 65 pips, trade 650. We add it. That means that now when you're at work and please don't tell me you're using your phone for trading, I mean. Once we reach the 65 pip mark in profit, right there, my stop loss will automatically move to 0. And now I'm risking the same as I'm willing to make towards my take profit, and it should just keep going. Even with pullbacks like this, eventually we'll hit it because I'm always 65 above the lowest market price has been. So let's say it goes here, it just misses your take profit and then pulls back here, then at least you secure all of this. So you secure everything, take away the grid, everything from your entry. So you secure 75 pips. The worst thing you can have happen to you, and that really screws with you, is when you have a green trade that almost hits your take profit and you wake up at the stop loss. Like, that's the most demoralizing thing you can have happen as a trader. First of all, because you knew you could have fixed it. By paying attention. Now, obviously, if you are in a position, let me point this out. If you are in a position where all you do is trade all day, or you are working from home and you have the ability to monitor your trades constantly, then manually moving your stop loss based on basic rulings of how to move a stop loss, looking at if I move my stop loss here, I'm willing to make X more and risking X of my profit, right? So if you're 50 pips into profit, you move your stop loss to 0, you're risking 50 pips of profit. If your take profit is only 30 pips away, you're risking pulling back more than you're willing to make. Fix the manual. Get the 1-to-2 ratio at least, right? Always keep in mind of that. Even when you're winning a trade, let's say you're 150 pips into profit and your take profit is a 170, there's no reason to have a stop loss 80 pips back. You're risking 80 pips, willing to make 20 more. Then just close the damn trade. If you feel it's not moving, just take the profit. Right? This is why I said there is no way to get 1-to-2, 1-to-3, 1-to-4. Average it out. Average it out. Okay. Now, one final thing, trade management. So entry and exit, I showed you a little bit. If you use technical analysis, go to the chart. If you use technical analysis, this I did 3 weeks ago. You can identify where it is. And this is very simple to do. First of all, technical analysis, top-down analysis, you get, I'm pretty sure you all know this. If you don't, different webinar. So you do your analysis. Let's try to find a chart where it might still not be, because this is also kind of in a spot. Let's start with a day to get a good idea. Let's look at, okay, what did I say? 80 CAD. Oh, come on. Why are you doing this to me? Maybe. Yeah, I know, because if I take the bodies, it will look like this. I think that's, so it actually starts here. No, kind of broke it, but not really. What's this day? Close outside, pulls back in. It's a bit unstable. All right, let's try to find a different one. Let's do CGFGPY. I'm just trying to find one that's not in a position yet where you have to extrapolate, so you get that real fast. If it loads. No? Okay, let's do this one then. You're a GBP? Oh, okay, perfect, yes. Okay, so you're a GBP. Let's take a look at first, big picture, where we at, what are we doing? A whole bunch of nothing. We're basically moving sideways, but all right. So it went down, stopped here, went up, double bottom, then slowly starting to move up. Okay, so here we're slowly starting to move up. So we're looking at potentially buying opportunities more than selling opportunities. And on the day, we can't really get a good channel here. That's probably because it's very, very young. It's only stopped here. It's only just started. It could be this. So we have a converging point. That could very well be it. So we got something like this. So we want to buy. Ideally, you can already mark it, right? I want to ideally mark it here and go there. But this is on a day chart. This is a little bit wonky. So let's fine tune this a little bit, shall we? If this is going here, it hit here, then it hit here, it's kind of moving sideways. So the perfect entry would be somewhere around here. What does it look like for my hour trades? This is going down, that broke, so right now we're going back up. So we're going up here. And then, well, the equidistant would be something like this. It's not that important right now. that is probably going to bounce off this level somewhere. Right. Is it this level? No. No, we're going to go with this. Quick and dirty. So most likely if we extrapolate this information, we're going to do this. And then we could do this. Or we could do this. And then into this, right? I hope everybody understands what the hell I just did. Because we want to buy. So ideally we want to buy when it's around this level. So insert objects. I'm just doing the label. Where's my thing? Oh, there it is. So basically, ideally, we want to go in somewhere around here. Because in the bigger picture, we want to buy. So if we can buy somewhere where it's at the bottom of that line, we can write this, because there's a horizontal level somewhere around here. Then my stop loss would basically be outside of that. I'll use that one. So let me make this the thick line. Right, so somewhere over here. So if I go in here, I'll have a trade somewhere from here going up. My stop loss will be here, which is a 60 pip stop loss. And my take profit will be, well, at the top here. So that's there. Now, if you're trading on an hour, right, you're going to have your hourly resistances in here as well. Which is, I think this one. Yeah, someone. Oh, perfect. Like if you get it in here, that's even better. So you can put your stop loss just right outside there. Snap it in there. I'm just doing quick and dirty, guys. Quick and dirty, because obviously I don't want to keep you too long. So that's in the scenario. My entry is over here. My stop loss is over here. I'm identifying this because I can factor it in now. That is a 15 pip stop loss. That's really tight, but it is Euro GBP. That makes sense. And then I can even do like an hourly trade. It would look something like, well, till the next resistance, which is support, in this case, resistance. Somewhere over. That's probably going to bounce off of this first. So I'm going to go a little underneath it. This would be my hourly setup. 15 pips, 30 pips, 1-to-2 ratio. That's perfectly fine. And then I could even put in a trailing stop along somewhere on halfway of 100 points. Right? Make sense? I know I go fast, but that was quick and dirty. Okay. We'll have more time for this in the Q&A. So the duration is pretty simple. If you look at your portfolio, how long a trade's going to take, like I did here, right? If you look at how long does it take to go from point A to point B, you can do that with all of them, right? You just put these arrows in, let's say, which means that if you, there's only two here. If you put these next to each other, there's a little bit of an average line, which is basically something like this is roughly the average, right? So you just put that on there. If I go in from here and I follow that line to my take profit, wherever that may be, in this case, it says 20 bars. I'm in a day chart, so that trade will take about 20 days of going down, up, and then up. It might hit it here already. Obviously, it could accelerate, it could take longer, but on average, this should take about 20 days. And portfolio of trades, we talked about this, right? So your capital bracket determines what your portfolio trades is going to look like. You don't want to trade one trade at a time. You want to learn to trade at least 5 trades active at any given time with several other potentially good trades that you can back it up with in case one is not developing or you overlook the fundamental and it hit your stop loss and stuff like that, that you can just replace it and keep the account moving. The worst thing you can do is have the account sit still, do nothing. But at the same time, don't force yourself to take a trade because it's sitting there doing nothing, right? If the trade is there, you take it. If it's not there, you don't. But once you have a portfolio trade set up, there's going to be short ones in there, there's going to be long ones in there, and they will rotate each out. Once you start getting a hang of it, your account will always be moving. Some trades take weeks to develop, others take hours. And now you have a balanced portfolio, not only in currencies and securities that you have in it, and exposure ratios and risk levels, but you also have different tempos to keep the account busy. This is actually kind of good for us because we are all people. If I would tell you the euro US dollar goes up by 3% this year, in January, open a trade, put everything, this is 100% guaranteed, let's say, and you put all your money on buy, how many of you could actually not touch it for a year? With all the crazy stuff that's going to happen in between, right? It's going to crash all of a sudden. Now you can answer, he was wrong. I told you it was 100% guaranteed. And at the end of the year, it does do the 3%. Exactly. Like, we are just, it's just not in our nature to not mess with it. So a lot of people don't have this. Now, when you get to offshore investment, you do things like structured notes. They take 6 years and you can't touch it. Right? Or managed accounts and stuff like that. Big investment, offshore investments. But that's a completely different story. Okay. I overshot it by 10 minutes. Okie dokie. So for those that are going to be are on YouTube or leaving us, thank you very much for watching. I hope that everything I said kind of made sense and that you can use it, and that the examples helped. Go to YouTube if you aren't on it. And obviously, if you're on YouTube, check out all the other webinars from Legacy FX's channel for any topics that you might be watching. And I hope to see you on a live webinar next time. Okay, and for us, after I have a sip of water, this is Q&A. Now, before we get into the Q&A, for those of you that are going to be leaving that don't stay for the Q&A, please note that at the end of the webinar, usually it sends out a survey. It is really helpful to me if you guys can fill it in, because it tells Legacy FX how you guys find my presenting and my content. That is from me. Constructive criticism is very welcome. But it also allows you to give feedback on what would you like to see next. We might have covered it already, then we can tell you we've covered it. Go check out your YouTube channel, type in Legacy FX, whole bunch of webinars that I've already done there, from technicals to indicators to price action to entry and exit, way more detailed, all these kind of things. But what you can also do, just general suggestions, questions you have about a Legacy FX, you just ask them there, right? You ask them to Legacy FX so they can read it. Now, if I'm not mistaken, you are all part of the Legacy FX group. For those that are already with an account with Legacy FX, that loyalty system that they have, they actually have me as a one-on-one webinar that you can pick from as your point claim. So if you have something that's very specific that not a lot of people ask for, I don't know. Let me say you want to know martingale strategy, name something stupid. Then you can specifically ask for that, and then I'll make the content and make a one-on-one webinar where you basically get me for an hour to just basically pick my brain. We'll do it based on a topic, but usually people just fly off into the distance and have 6,000 questions. So do that. Okay, having that said, I'm going to give the floor to you guys. Thank you, Mon, for your for your kind words. Appreciate it. I hope to see you again if you're leaving. Yeah, Q&A. Guys, fire away. What questions you got? When people don't ask questions, I always get confused. It's either they fell asleep or they didn't get it. Okay, good to know, Ashley. Okay, yeah, perfect. Yeah, there's also a different webinar, entry and exits, where I show a little bit different exempt entry points, how you calculate them based on if you have a more established trend, for instance, how you calculate the new growth of the new bottom, so you can get that take profit slightly further away from where the current bottom is. You can use TradingView to draw lines, of course, but Legacy FX, if you download the MT5 platform from Legacy FX when you have the account, you can use MT5 as MT5 works, which is all the lines that I just used and more. But I'm very glad you said that, actually. Happy, and I hope I answered your question. Thank you very much for your kind words, Thandoxulo. I hope I didn't butcher that name, by the way. I hope I answered your question, Ramachandra. Thanks, Gordon. Okay, so Bradley. Bradley has a good question. So about the trailing stop, when do you decide to move the stop loss? Is there a number of pips you should calculate? So let me just go back to that one real fast. Okay. Let's take this example. All right, Bradley. So let's say we're going in for a sell. Okay. I got my stop loss set up. I got my take profit. Let's forget about all of that. My entry point is whatever the market price is right now. Which direction are we going? We're going sell in a selling trend. So everything in this selling trend, when it's selling, what I care about is how much does it go back from the lowest point it's been at. So let's start here. We go down. Now we start here. This is a low point, and then it went back up, right? It went back up for 1,117 points. So very easily 110 pips, right? Then we go down, we go down, we go down. We have a wick, and we go back up. This is the highest point it went to, 168 pips. Right? Then we had a weird gap opening. So yeah, you could calculate this, but there's 100 pips again. And we go down, 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 and well, you're at the bottom of the channel. Right, so here if you had a trailing stop of over 115 pips, you would have never hit it and you would have been good to go. Then we went up, we wait for the reset. Obviously, if you have a bigger account, you can buy the reset as well, maybe at half the risk, 1.5, because you trade against the trend, da 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 da. Now we do the same thing again. We're going down, you're in your buy. It doesn't matter if you went in perfectly or 2 days late. Low to high, that's on 100 pips. Low to high, 100 pips. Low to high, 100, well, this is the same, so it went from here. That's 170 pips. It's a little bit more, but you can see it's a bit more exceptional because it basically went back to entry point. Well, let's say, okay, so that's 170. So we had 100 and 170. Let's keep that in mind. Take profit. Okay. All right, so here we had 100 and 120. Here we had 100 and 170. So 110, 120 is 230, 170 is 3, 4, and then 500. 500 divided by 5 is 100. On average, okay, let's take 130 pips. So 130 pips pullback would only knock me out if it does something weird like this, which is more than exceptional. And that's okay because this might have well just like wicked through or something. So if I set up my trade here at 130, I just right click the entry, trailing stop, custom, 130 is 1,300, right? This is in points. 130 pips, add a 0. Done. Trade's done. This trade will now, right, let's say you had your stop loss here, you had your take profit here. At 130 pips, it will automatically move to 0, which is actually, if you have a line like this, double check what this line is. If this line is at 100, Make the trailing stop 100 because it could bounce off of this first. And in this case, it actually adds up. It's 146. So it will already be in zero and have a slight profit secured by the time it gets there. And then it can bounce back here. But even if it does that, like bounce back here, it actually needs to break the trend to get here again. And then it just needs to go through these levels. And when it breaks this, it'll probably just go there. Right? So I hope that answers the question. Bradley. How can you calculate the pips beforehand? Okay, so basically what I just did, right? So if my entry point is going to be market price in this case, and based on my technical analysis, I know my stop loss needs to be outside trend, outside resistance. It needs to be somewhere over here. And before I open the trade, I already know that this is going to be the distance of my stop loss. I never look at my take profit until I just decide to open it. And the reason for that is because I want to double check my ratio before I open it. But the only thing I really care about when opening trades is how much money, I know it's 3%, but where's my stop loss? Where is it going to be safe that I only lose money if I actually get this trade wrong? And by wrong, I mean it actually just broke the lines and I have to throw all my drawings in the trash and start again because it broke the pattern. Because remember, let's say you were late and you were already late, right? So this trade already started like way back here. If you trade every single time it touches the top, every single time, blindly. So let's do this trade. So you missed the first one, you wait, okay, go in for a sell, win, sell, win, sell. Well, this one closed outside, so, but okay, let's say you went in anyway, and you lose this one. 2 wins, 1 loss, fine. Go, well, this is too aggressive to go through. I don't think anybody would have done it because you would have already removed this line because it broke outside of it. And now you have a reset. Now you create a double top. Oh, okay, now we have a double top. All right, you missed this one, you go up. Sell 1, sell 2. Now let's say you win this one, that's 800 pips, and you lose this one, that's 120 pips. Do we really care about the 120 pips I lost over the 800 pips I just made? I'm just doing the probability. It's more probable to sell than to buy. Now, I know some of you have this idea like, okay, but I'm going to beat the market because the price is really low, which means it's highly oversold, which means that it should go up. Says flippin' who? As long as big investors are buying against the euro, so in this case, euro, US dollar, they're buying dollars, the volume is in favor of the dollars. Guess what the market does? It goes in favor of whatever has the most volume. So unless they hit the strike date or liquidate the trade, your $2.50 is not going to affect the change in the market. You're not beating the market. You really think you're going to affect a $6 trillion market? Even if you have a $500,000 account, you're still a drop of water in a very big ocean. Don't try to beat the market. Just go with the market. Just understand why the market is moving where it's moving. Try to understand how it moves by reading what it did. I literally in my head do this. We go from up, we went down, a little bit of delay, down, up, consolidation. Okay, so this likes to consolidate halfway through a lot. See, consolidate again. Okay, made a new bottom. Oh, we had a double top, so, okay. And then it made a really big, so it basically just caught up on this. So it accelerated to catch up with this, but it kept the acceleration because there's volume. So yeah, the probability of it selling is really high. I don't see any fundamental reason at the moment. Let's say I'm reading the fundamentals as well. There's no real fundamental reason for it to not go any further because people do this. Ah, but look, in the past, look how often it's here. Yeah, but this is before COVID. This is after COVID. Plus, there's a war going on. I don't know if you noticed, but the market is not exactly the same as it was in 1984. So yeah, I hope that answers that question. Okay, let me just see where I was here. Oh wait, why did it go back up? Hold on. Entry measure. That we did that one. Calculate pips. Thank you for your kind words, Kadar. Rama, thank you. Here's the next one. Okay. By the way, Bradley, I hope that answers your question. Janet, hi Mike. When the trade is not going away, do you close it immediately or wait for stop loss? Okay, so the way that this works, right, Janet? Look at this setup. If it moves into stop loss and it just hangs around here and goes here and goes here, why is that stop loss there? It should only hit it if the pattern gets broken. So in the early days where you're going to go into negative 9 out of 99.9% of the time, let it develop. Give it time. But if you're, let's say, and this is a day chart, but let's imagine this is an hour chart. You're like 8 candles in, you're all the way over here. The line should have been underneath here by now, and it's still hanging around here. This is what I mean. You're 8 hours into the trade. It hasn't developed. It hasn't corrected itself back into the channel. It's hanging on this pressure point, which means that the sellers and buyers can't agree which direction we're going on. Be the first. Get out. This is not developing. This can now go either way. Get out. Take the small loss, whatever. Find something else. So it's situational. If you're 2 hours in and you're over here, no, I'm not going to close it. I have a stop loss for a reason. It has all the time still to correct itself back in. But if I'm 10 hours in and we're over here, look how far we're away from the channel now that it needs to correct. We're barely at our take profit with where the channel is. I should have been there already. So something went wrong. So let me get rid of it. I'll find a different trade. It did not develop accordingly. How to calculate how much volume should I buy? I hope that answers your question, by the way, Janet. Jean, how do you calculate volume for, let's say, $250? Okay, so you mean lot size. Well, take it simple. All right, if you have 3% risk on your account and you have a $250 account, what is your risk? If 10 is 25, 12 and a half is 5, so roughly half of that is about $7. So if you have a 10 pip stop loss, right, you can take that, which is extremely tight. And this is where the problem is what I said, guys. Capital, low capital is high risk because you don't have any room. Apart from the fact that I would highly advise you to take that 250 that you have, put it in a separate account and add it 4 times till you get to 1,000 and then start a live account and practice on demo until then starting with a $250 account. I mean, even for me, starting with $250 account, that's almost like a challenge to make that work because there's just so little opportunities you can take because your stop loss is going to exceed your range even on a 1 micro lot so fast. So it's better to just get more capital. But basically how you calculate it is 3% of 250. So that's about $7. So if your stop loss would be 70 pips, you can take it on 1 micro lot because that'd be $7. And that's your limit. Any stop loss higher than that, you go negative under a micro lot, you can't take the trade anymore. And that means that you're going to be stuck to things like watching paint dry. Now, this is an overlay from this is our Euro US dollar, forget about that. Look at this. This whole climb was 248 points. That's in days. If we go like hours, let's take the last big climb in hours. That's 60 pips. You would be trading Euro CHF basically with a small account like that. Because the average daily range is pretty small. If we look at the average daily range, the ADR, if somebody ever asks you that, right? Negative, that's 70, 60, 60, 60, 60. I'm starting to get bored already. 60, 80, 80. Oh, look, we're accelerating. Woohoo, we're making money. 100. I'm back to 60s, back to 60s. Right, so about 60 a day. That is the entire range for a day, so you have room. So small accounts, you trade Euro CHF, and it's also great for practice because it doesn't have a lot of like breakouts and stuff. Okay, so Malefe, can I please elaborate on the quarters theory? I have to say that doesn't ring a bell, but I've probably done it, but just don't know the name, so I'm sorry on that one. Particularly, how does consolidation points appear on the market? That is very dependent on the market. Now, there's two types of consolidation points. Let me put it that way. You have price level consolidation, and think about it this way. Us traders have OCD. And I mean that in the following way. We like round numbers, right? Look at the past and look where charts turn, where they stall. And it's usually going to be around round numbers. Like the euro, it's going to be 120, 115, 110, 15. Why? Because, well, that's a low point and 10 is very low, and that's where a lot of take profits are for sellers and a lot of pending orders for buyers. So the second it gets to that price, everybody closes and everybody opens at the same time. So this is where you get these swing moments. So this has to do with prices. So there is a value to be gotten out of variable price levels of certain pairs. But this is like, this will take some practice because every pair is different. Like there are specific markers for pairs where price points are that are basically consolidation price points, right? So if you think about oil, $100 a barrel, $80 a barrel, $50 a barrel, 25, right? These are very critical price levels. And then above that, I don't know. I hope we never get there. But for gold, you have a very big range. There's two very big price points. There's one bottom and one top. And the reason for that is the bottom is where there's a mass bulk buy price for the actual physical industry that uses gold, and then a top price where they stop buying because the price gets too expensive, which doesn't allow them to sell the product anymore after fabrication. So that's why there's a range on gold. This is every single currency. I hope that I understood your question right, and what I just explained makes sense. If not, just yell at me. But quarters theory, it doesn't ring a bell. Maybe if you give me an example, I might have seen it, but it doesn't ring a bell. Is there a more detailed video about auto charts where they show you how to calculate TP 1, 2, and 3? I haven't done it. Put it in the suggestions. I might be able to do that. I mean, I just use technical analysis to identify 1, 2, and 3, but you can do it with an auto chartist, yeah. Can we draw blocks of days and try I hope that answers your question, by the way, Dad. Mike, can we draw blocks of days to try and predict highs and lows? What do you mean by blocks? Can you elaborate on that, Rama? That's the same question again. Yeah, you're imagining things, Gordon. A demo account is literally virtual money. It has zero effect on the market. You can open $10 million value trades. It's a demo account. It doesn't exist. It doesn't get factored into the market. Nothing happens. Demo accounts are good for practice to a certain level. There is a limit to how good they are. And this has to do with, well, first of all, you're not feeling the heat of risking. And this is a little bit psychology. I hate mentioning psychology because this is like one of those scammer traps. Like, oh, you just have to get the right mindset and you'll do fine in trading. This is the stupidest bullshit. Sorry, stupidest stuff I've ever heard. Because it's not. It's a numbers game, and it's basically probability. It's literally probability. What is the higher probability, sell or buy at this point? Done. And there's ways to calculate that and ways to find that and to get a good estimate on the most highest probability of what's going to happen next. You're not going to get it wrong all the time, but you don't need to. If you look at the variable lot size, I show you an example where with a 40% win rate in 100 trades, 40% win rate, literally worse than a coin flip, your account is growing. So, um, so yeah. Uh, but yeah, Gordon, no, well, that's the question. Okay, so Monday is a very valid question. So trading a weekly time frame, good for someone who is working. Generally speaking, the bigger picture is better because you do need to understand you get less entry points because you have to wait much longer. But once you go in, you also have a much bigger trade. However, I would advise a day. Use a week to get a good overview of what's happening because a week is really like quarter year trades. Like you should set them up for Q1, 2, 3, 4. Like you're really looking at, like if you look at big investments like offshore, they look at Q1, 2, 3, 4. They look at a 1 year window and extrapolate that to a 5 year window or 6 year window, right? If you look at structured notes, they're usually between 4 and 6 years of runtime. So, and then get paid out quarterly by a ticketing system. But that's beside the point. So I would say use a week. What I do is I analyze a week to get a good idea of what the real big picture is doing, because the week doesn't change all that much. Like it goes down, it goes back up, and now I see with the quarter. I'll get back to that in a second. It goes back, it goes down a certain amount, and then it corrects itself up back a certain amount, or it goes up and corrects itself back down a certain amount. Fibonacci, Elliott wave, like all these things have been applied on that. But a percentage growth per year is there is a limit to how much a currency can get stronger in 1 year, because otherwise the economy would crash if it does more or less. Like either the one, it's inflation goes out of the yin yang, right? Look at some exotic pairs and look at inflation in those countries where you have like a 300% growth in currency value or decline, and look what happens to inflation. It literally spirals out of control. So if you look at the established Western majors, then there's a limit to how much they grow in a year. And it's usually like pretty controlled. Like they can go up 10% and then go back down 5% or 6%, and you still end up with the same 4%, which the bank then can use to control the inflation a little bit and keep it at 3.6 mark. But yeah, that's how money works. It's a great book. I forgot who wrote it. I always forget. I hope that answers that question, Manda. Okay, Rama, let me just check what going back. So draw blocks that way. Okay, I mean every day period 7. Well, first of all, there's only a 5-day period, right? Monday to Friday, which is technically Sunday to Friday evening. But if you are a little bit new, I usually advise against opening on Monday because the markets are one by one opening and putting in their pending orders and whatever was issued during the weekend that needs to be opened and inserted into the market and da 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 da. Tuesdays to Thursdays is your trading window because on Fridays you're looking to close. In most cases, you either want to secure your entry before weekend or get rid of the trade. Don't open trades 3 hours before the market closes unless you're a that's a technique. It's called It's getting late. Swap trader, but that's completely different. And generally speaking, you do that with real cash directly through the bank, so you get the maximum interest. And you automatically close the trade on Monday morning first thing when you just take the swap over the weekend. But then there's gap trading on Mondays. Like there's a whole bunch of different techniques you can do. But generally speaking, if you're retail trading like we are, I would usually advise people don't trade on Mondays. Just analyze the market on Mondays after the markets have all opened, so you can see generally how the weekend has developed. Because technically, you need to consider the market doesn't move on Saturdays and Sundays on the chart. In reality, it moves, and the price correction you see on Monday, a gap opening, is basically how the market moved in between those 2 days. So if you have a big jump, well, something happened and that made the market move up. And these pending orders that have all been put in over the weekend get executed Monday morning first thing, and boom, you get a gap opening from the Asian markets. I hope that answers the question. Okay, so next one. Hello, I'd like to ask about Fibonacci. What does it really calculate, or how does it work? Okay, complicated answer on Fibonacci. It's a mathematical equation of pullbacks, and now I think about it with the quarter technique, that is kind of what Fibonacci does as well. It calculates quarters, but slightly different. Because I saw a little bit of a quarter. I'll get to that question in a second. Now, how does it work? Well, it used to be developed in a market completely different than the one that we have now. This is why Bollinger Bands isn't as relevant anymore as it was. But, or Elliott Wave is basically thrown out the window at this point. There is a reason why Fibonacci still works, especially on major pairs, especially on things like Euro US dollar. Because it's a self-fulfilling prophecy. Remember, what makes the market move? People opening trades, right? Buys and sells, closing trades to flip the volume the other way around, right? If you have a bunch of sellers, they all close at a certain level because something told them that's the level where it's supposed to be closing, then all of a sudden you have more buying volume. Well, guess what Fibonacci does? It calculates those levels and people put their stop losses and take profits on them. Ergo, it fulfills its own destiny because everybody's doing that. So you learn how it works. I did a webinar on this. Go to YouTube, Legacy Effects. There's indicators. I covered Fibonacci there, I think. And I think I did actually a webinar about Fibonacci all the way together. You don't necessarily have to use it in your trades, but it's great for pullbacks and stuff like that on some major pairs. Don't do it on oil or gold. It doesn't work there. Well, less. Because it's way more influenced by demand, supply, and political and fundamental drivers than it is, a currency like the euro, which has a whole bunch of countries that can't agree on anything. So it's kind of doing nothing. Ramya, yeah, so I should have answered that question, I think. Hold on. So I trade with 2 brokers. And the broker's 2 TP points. Take profit points aren't the same? Yeah, that can be different. The reason that can be possible, that there's the different prices, because the executing bank behind it. Remember, the broker is only a mediator allowing you to trade. It's like the middleman. Because in reality, what happens is, and this is what leverage does, is you go to a bank and say, here's 100,000 euros of mine. I want to buy dollars. And the bank goes like, well, I don't want dollars. Okay, you have to pay a negative swap, first of all, for as long as you hold it. But okay, you get one standard lot in the market. So it depends on which bank is the liquidates the trade. Is the asset is the executing trading bank, and they might have slightly different levels based on spread and stuff like that. So you get slightly different levels. It shouldn't be a massive difference though, because the exchange rate is kind of like averaged out, but it can be different per bank. Yes. Right. Let's say in Europe you could go to, okay, let's take a Dutch bank. Somebody throw a Dutch bank at me. National Bank of the Netherlands, whatever. and then you go to Greece and you take the National Bank of Greece. They'll probably have a different exchange rate for the same two things. And it won't be very different from each other, but it will be a little bit. So yeah, take profit, you can make them the same number, but the chart could be slightly different. Yes, there could be like, 10, 20 pips difference between the two charts. This could be spread, different things. But yeah, it's because of the difference of the broker, the bank behind the broker. Unless they're manipulating the chart. That happens generally only speaking with non-licensed brokers. Jean asks, what is a zip? I'm not sure. You mean a pip, I think. I'm not sure what a zip is, unless you mean a zip file. The quarters theory is a theory that argues the movement of the price move in 3 quarters in the market, which are influenced by the consolidation prices in the market. So, okay, let me understand this. So basically what you're saying is that, let's say you have a market that goes from 1 to 2, it calculates that there are 3/4 points. So yeah, it divides it in 25% parts up to there, and then there's consolidation. Okay, it's not something I've heard of from before, but it does feel like that it has a lot to do with this is has a lot of tie-in with Elliott wave principle, which dedicates that everything moves in triple waves, where the second one is always the longest leg and the first one, and then it could never be the shorter one than the third one, and whatever. That's a whole brain story as well. But then you also have the consolidation prices. Yeah, because again, look, if you think about Fibonacci, is the same thing, right? You have 32, 50, 68. Like you go through the same. They're slightly more deviated than 25, 50, 75, but it's a similar idea. So I can see that there's a relation there. Yeah. But again, this is more self-fulfilling prophecy, because as long as a lot of people are trading to a certain price level, like consolidation points, especially rounded points, yeah, about every 25 or 30% growth in a market, you have a lot of people that start closing positions. And when you look at market executors like market makers, they don't trade on this. So it's not them doing that. Right? They trade a quarter of a year or a year. They take a position, they hold it for a year. And then, with all the other positions, like let's say you have an offshore investment, cash, FX, and then you have real estate and stock market and I don't know, pension fund and insurances and all this kind of fun stuff. You have all this together bundled into one bundle that runs for a year. So what the FX does on itself within the portfolio could have a portfolio manager that adjusted every quarter of a year, which would then reflect itself on the monthly, weekly chart, which basically trickles all the way down, because that consistent behavior would trickle down to people trading in the lower because they utilize this pattern. So I think the quarters theory would make sense then, yes. But I'd have to look it up. But this is just from top of my mind how logical this chain works. I'd have to look it up. I'll be God honest, exactly how it's set up and see if this is a thing. But it makes sense. It sounds like something I could see that you can find relevance in, especially in certain markets. Yeah. But I have to look it up to give you a real answer, Malefe. Sorry. Swing trading. What about it, Petra? Do you have a $50,000 account? If the answer is no, forget about it. If you want to properly do swing trading, I mean. Okay, so somebody asked you, how do we trade gaps? A trade opens a gap, and there's always a reversal to fill the gap. And how does that happen? Because I get confused. Okay, Thanduk Silo. So let me explain this. On Friday, the market closes at 1, right? The price is 1. Saturday and Sunday, the market doesn't move, but I don't know, a plane crashes and hits a gold reserve. Just bear with me. That obviously affects the economy of that market. So let's say that currency is now declining in market because, okay, this is going to do damage to the economy. The market doesn't move on your chart, but in reality, the new market is being calculated already. The chart is actually moving in the background. So on Monday, when the markets open and the charts become active, it catches up and it opens in that new gap. Now, what happens is everybody that had, if in case, let's say it goes up, the gap is up, everybody that had a buy is now going to take this opportunity to get rid of it, and the sellers are stuck with it, so that it starts going down. This is usually why it starts closing the gap. Apart from the fact that there are traders that literally open a trade in the last few minutes on Friday just to close it in the start of Monday because of the gap openings. And this is why it's just the price correcting itself from the volume switch. So people closing positions and stuff like that. That's basically what makes it pull back in. And this is why usually, unless there's a really big reason why it had a gap, but usually why it closes itself and then continues whatever normal curve it should have had. How do I know when the price is losing momentum? Okay, Sato, this is a good one. So how do you know when the price is starting to lose momentum? If you see that the new bottoms or new tops are getting slightly less and less further away from the previous high top, so right, let's say, let me go to an hour here just to get a few. So let's say you have this stop to this stop to this stop to this stop to this stop, and at first it's like this. At first it's 28, and then it goes to 15, and then it goes to 5. It's losing momentum. It's getting less and less newer highs. And eventually that means that you know that it's going to start consolidating soon. And that's when you get this anxious point of either it's waiting for a fundamental announcement, right? Economic calendar. Either it's at a resistance or support level where it's just a certain price point where there's a lot of pending orders, like a round number, 1.05, 1.10, 110, like stuff like that. And this is generally speaking, if you're not too far away from your take profit, it's just, okay, just take the profit. There's no reason to try and make 20 pips more if you're 80 pips in profit or 50 pips in profit. You're risking 50 pips to make 20 pips more. That doesn't make sense. Just get rid of it. If you feel like it's flattening out, get rid of it. Now, if you like, well, I kind of want to see if it does it, then just manually move the stop loss to just underneath wherever the market price is. So 10 pips on the market price, so you're risking 10 to make 20, but you're at least securing the 70 pips profit that you have. And this is only in those cases that you really want to see, like if you got your take profit right, because sometimes it's just fun to challenge yourself. I hope that answers that question, Tato. All right, Gordon, this is a good one. So straddle strategy, basically setting pending orders above and below price points just before news announcements hits. This is fundamental trading that is really tricky to do. And think about it this way. Consistency wise, you're banking on a big spike that you know to nail. That's a gamble. And if you get really proficient at it and really understand how the market reacts to when the number is predicted X but comes out Y, how the market is going to move in what period of time during the year, at what time of day, then yes, it is a good technique. Like every technique has a value to it if you get proficient at it. But things like scalping and this kind of technique, there's a lot of risk. You need to get it right quite often in order to make it profitable. Because remember, you're basically going in and out really fast, trying to grab the spike, and you're not really trading with a stop loss. So if it triggers your buy stop when it starts to go down and it spikes down, either it hits your stop loss or you don't have a stop loss, and all of a sudden you see your account just going straight down the drain, depending on your lot size and how fast you can close it. So it's very intensive. When I lose money on a trade, I hope that answers that question, by the way, Gordon. When I lose money on a trade, where does my money actually go to? People like me who win their trades, to put it blunt. It's a null sum game. So if it's a $6 trillion market, there's $3 trillion going up and $3 trillion going down. And whoever is winning that day is getting the money from the guy that didn't win. A woman or picket fence or attack helicopter, whatever you identify as, I don't judge. Right? But obviously it doesn't go directly to me and directly, basically the mediator. So this is a whole different story. So the broker basically makes money in 4 different stages, and this is a joint venture with the bank. There's something called a finance turn, then there's spread and commission. Then there's a hedge trade that automatically opens when you open a trade. They open an equal and opposite trade. So if you lose your trade, they win their trade, and basically you pay them. And then there's the finance turn with the market. So this is basically what happens. But whenever you lose money in the actual market, it goes to somebody that won their trade. So if you look at the big scheme of things, this is going to sound really condescending, don't get this wrong. The trading market, the executive, the big guys, Goldman Sachs, GAM, Gap, all these guys, they're called smart money. And we're called dumb money because we are millions of people trading little bits. But guess who funds the big guys? Their 32 million or 300 million pot needs to be paid for by something. Well, guess what? 300 million throwing 30 million people throwing $10 at it. Well, that's enough money to cover it. The many pay the few. And it's not like they have access to something we don't. They just have a bigger pocket. And like I said, the more money you have, the less risk you take in this market because you have more opportunity and more right? More access to more things at the same time. Unfair, but true. Joshua, so he says like you talk about the 2 central. Okay, so in these examples, yeah, so you have a micro lot. It could be a mini lot, it could be a standard lot. Depends on your lot, on your account, right? But if you have a broker and you cannot trade anything less than a mini lot, it could be a policy of that broker that you cannot trade micro lots with them. Now, I'm not going to speak for any broker. In case if this is the case with Legacy FX, you just contact your. I'm pretty sure you have an account manager or like a representative or somebody. If not, just send an email to webinars@Legacy FX and ask them about the policy for that. Because it could be that the executing bank that they have doesn't allow microlots, which means that they don't allow microlots. Now, doesn't mean it's not because of your because of an account size. That does not limit this. The only thing an account size limits is how high you can go, right? If you have $1,000 account, you can't open a standard lot trade. Well, you can with a 1-to-100 ratio, but I really don't advise you doing that because you'll just see it go blip and it's gone. Yeah. So but what I would do then in your case, same with the example earlier, 250. You really want to start the account with between 1,000 and 1,500. So if you have 500 now, do yourself a favor, and if you can't keep it in a bank account, make a separate bank account and just deposit in there a little bit of money every month. This is your first step to investing. You're investing in yourself already. Put some money on the side, build it up till you have a good starting amount, practice on demo accounts so you have a little bit of a good understanding of how markets move and you keep in touch with how the markets are moving, if they're accelerating, if they're slowing down, if they're bullish or if they're bearish. And you follow a few webinars along the way, and a year down the line when you have all the money, let's say, you open an account, you can confidently sit down and slowly start. But ask for help. It's okay. I know this is not something we guys do. Ask for help. It's okay. Just make sure you double check who you're asking for help. So a lesson I learned hard too. But yeah, preferably somebody that's not affiliated to the broker you're trading with. Just saying. Mike, how would you spread $1,000 over all major forex pairs, and can you spread say $100 over 10 major forex pairs and make money? You can. I shouldn't. Right. Okay. So let's say you take 3% risk. How would I spread my $1,000 over major forex pairs? Well, first of all, majors and minors. Never just majors, because then you just run out of pairs way fast, right? But basically, I would use 3% and I would go 15 trades, which is roughly 50% of the account. Well, it's 45% of the account. So I'm using $450. That's my maximum stop loss total. That's if all 15 trades hit stop loss, which is not going to happen because even the worst traders I've seen have better win rates than 1 in 15. So basically what you get is that you will never get margin called if you're in your European account, guys. If you're in MiFID or something, we get margin called at 30%. So this protects you from that. If you're outside of Europe, then feel free to do more and use the full amount because you can't get margin called. So use up to like 10% left. But that allows you to use a drawdown and try to get your exposure to any single pair to less than 10%, or less than 20%. So if you have 10 trades, €2, $2, £2, 2 yens, and throw an oddball Netflix CFD in there, right? And then throw in, let's say you want another tech one, you take Zoom stock, or the Dow Jones, or the Nasdaq, whatever. This way, your exposure is like around 20% across the different currencies and industries and blah blah blah, and you're utilizing your full capital to keep the account and find opportunities. Hope that makes sense. Okay, so Gordon, how does legacy effects or all brokers make money? Where does the money come from to pay out a trader when she makes a profit? So that's basically what the bank secures that's behind the broker. They basically provide a loan to the broker. And this is why they hate institutional accounts that win, because it screws up the cash flow. Because the whole concept of a broker is making money on small trades that about 70% lose and 30% win. And they don't have to do anything about this. This is people to just do themselves. All right. Most people do trading, do weird things, and 80% of people just lose their money. It's that simple because they're too stubborn to ask for help. They're too stubborn to learn, and they just think, I can do this, and they don't really care, and they go in and half-ass, and you all know this thing. So that's one side of this coin. The other side, like I said, there's something called a finance turn. There's obviously spread or commission, and this is like a payment. If there's commission, then that's just a fixed one, and spread is basically the little flip that every trade pays them. And apart from that, every time you open a trade, no matter a buy or sell, the system automatically opens a trade the opposite in equal direction for the same size. So if you lose, they win. If you win, well, they lose, and they're basically paying you. So it balances out to zero. And then looking at 80% of people lose their money, and then the benefit of finance turn and spread and commission, you end up making money. And this is why the bank will lend them the money. Can you surely show that 28, 15, 5 again? Not quite sure what you mean by the 28, 15, and 5. Malefe, look, just Google my name. I'm sure you can find me. I mean, I'm not going to blurt it out, but Google Mike Rotting. Trust me, you'll find me. Okay, so the difference between candles, it depends. So somebody asked me the difference between normal Japanese candles, which is the candlesticks that we're looking at now, or Heiken Ashi, which this stuff. I can't decide. I've personally never liked Heiken Ashi because it just looks ugly, and I just can't. It looks like, but whatever. That's personal. It depends on how you're going to trade. There are certain techniques that use Heiken Ashi candles for a reason because of the way that they're built up. And there are certain techniques like price action that only works with candlesticks. So it depends on what you're going to trade and how you're going to trade it. Generally speaking, I would advise take whatever fits your style best. And for most people, that's going to be candlesticks because there's just the biggest variety on it compared to Heiken Ashi. If you have a specific technique that you already found that you really like that works for you with Heiken Ashi, then go with Heiken Ashi. It's that simple. How much higher volume can you? I hope that answers your question, Gordon. Jean, how much higher volume you can buy for a trade? Okay, correct me if I'm wrong. Do you mean how much can you go over your 3% mark, let's say, to take a trade? I would cap it at 5% just because then that way with 10 trades, you're already utilizing 50% of your capital. With 20% down draw, then you're already at 70. Right? So factor that in. But generally speaking, you just want to stick to 3, like especially if you're early and you have a small account, you have to learn to be patient and only pick when the market is basically in prime location to take it. Let me do this window again. Doesn't matter for the recording, they take this out anyway. So the increase in pips is calculated from bottom of the wick to the top of the next wick, right? So if I want to calculate this pullback, you would calculate the lowest the market price has been, because your trailing stop in a sell goes down, to the highest point it's retraced. So not this, this. All right, I hope that answers that question. Yeah, Malefic, for legal reasons I can't, but I just told it. Let me just check. You say wait, what? 106, okay. Oh, I'm so breaking the rules here. 106, what did you say, 106, 7. Got the stupid thing in the way, hold on. So right about here. Now I got the chat in the way here. So you're somewhere over, oh yeah, you went in a little early, that's okay. Like, look, think about it this way. What is more probable to happen? It going here or it going here? If the answer is it's going here in your mind, that's past your entry point, so then just hold it. Right? That's how I approach my trades. I'm not saying that's what you should do. You need to make up your own mind. That should cover me legally. Oh, damn, we actually made it to the bottom. That was a long Q&A section, actually. All right, that's okay. All right, does anybody else have any further questions? Last call for the bar. Yeah, I do. So look at the webinar that I made on calculating. Like basically what the line chart does, if you have candlestick, you have all these wicks, right? And if you're trying to find a horizontal line, you want to have 3 connection points or more. And the line chart just takes out all the noise, so you can just quickly find the 3 points where it connects or almost connects, and then you switch to the candles, and then you see that the wick connects, so it got rejected by that line. If you go to YouTube and you go to Legacy Effects, there is drawing technicals. Basically covers that. I even color code the lines because that's what you should really do. Obviously, quick and dirty, I'm not going to do that. But you know, between week, day, 4 hour, hour, whatever your your 3R. You should have 3 charts, and then you color code them to make it easier for yourself. If we talk about risk management, what exactly the risk we're managing, and what are the key points to help manage the risk? Does it include calculations? Yes. So risk management includes your risk level per trade, which is variable lot size basically, your exposure, right? So controlling your exposure. It's also controlling that your balanced portfolio is spread out correctly. The other part of risk is not taking trades, let's say, by calculating your entry points correctly. So you're not taking unnecessary risk, making sure that your stop loss is outside at least one support and resistance, or at least outside 2 lines, basically. So if you're in a channel, that it's outside channel, outside nearest resistance, so that it should only go there if it actually breaks the pattern, and not just from a wick because it felt like it, because too many people pressed buy. And then change their mind. Right. So these kind of things is all part of risk management. And then you also, a little bit further down the line, get diversification in portfolio as part of risk management, of micro risk management, like trailing stops, moving your stop losses, time of day that you're trading, depending on what you're trading, the industry you're trading in, depending on if it's the Asian market, European market, or US dominant market, so that you pick your trading times. This is all part of risk management. Because when you line all these things up together with a trading plan that has this risk management in it, you get a streamlined approach to your trades and you create consistency. And that is basically the main thing you want to create. Consistency. Yes, you could go in with 10K and maybe turn it into 100K. You have more chance going to a casino, put everything on black 6 times in a row, have a 49.5% chance repeating and walking out with everything. That's a higher percentage chance of making that happen than it is in Forex by just going all in all the time. And this is why risk management creates consistency. And that's how you grow an account over 10 years and not blow it up in 2. Just follow the rules and adjust when the market changes. Because the market changes from time to time. I hope that answers that question, Stembiso. I hope I didn't butcher that name too badly. Sorry. All right. Yeah, do Gordon. I got a bunch of webinars on there. I've been doing this for a year for Legacy FX, I think. There's a whole bunch of topics on there, including risk management that we just did, but more in. Anyway, yeah, today was more like from the perspective of if you have a portfolio of trades, and that's more on a bit more specific. But anyway, to check them out. They're all like about the same time. They don't have the Q&As in there, like I said. All right, let's cut it off. So for everybody, again, thank you very much for coming. Thank you very much for watching. I hope you all enjoyed your time. I hope you learned something. It was a good webinar from my end. Lots of Q&A, so that usually makes me happy. But quick reminder again for those before you leave, the survey that's sent out at the end of the webinar, I would always highly appreciate that if you guys could fill it in. And other than that, I hope to see you guys next month for our next topic. I don't know what it is yet. Legacy FX hasn't sat down with me. We'll probably do that next week. So there'll probably be another one next week. New topic, different topic. Maybe based on you guys' feedback. And then, as always, guys, trade safe, trade smart, and see you in the next webinar.